Alrighty, we are live. Welcome to the CRE News Hour, a weekly podcast where we come to you at 3 p.m. Eastern Standard Time, talk everything commercial real estate and all current events. I'm here with my co-host, Rafael Cazzo. How you doing, friend?
How's it going, man? Happy New Year. It's the first episode of the year. Excited to start off the year with a bang.
That's right. Well, listen, my name is Henry Design. We come to you live each and every single Wednesday at 3 p.m. Eastern Standard Time to review some articles about some current events that are going on the commercial real estate front. Today, we're going to be talking about affordability in the market, construction spending, hotel pricing, and some multi-family data that I think everyone would really enjoy seeing. So where do you want to kick things off?
Well, we'll get it kicked off here. I'm going to go share my screen for an article that I found. It is actually a overview of what a host of different commercial real estate professionals feel 2024 is how it's going to play out. So the interesting thing about this particular article is that they interviewed hundreds of different commercial real estate executives around the world. So they have people tuning that they surveyed from Paris, London, New York, Los Angeles, Dublin, Chicago, Houston. And there's obviously several other states and countries that they profiled as well. And they condensed it down to the top 40 answers that they received for this particular survey. So it's kind of interesting to see how people in different markets, not only in the U.S. markets, but also internationally, what they had to say about the future. So, a lot of the recurring themes, I'll just kind of provide some summaries to the article. A lot of the current themes seems to be similar, is that no one knows really what's going to happen into 2024. However, the predominant sentiment is that it's going to be in a better from a transactional standpoint than 2023 was. And so as we start going through some of these, these different outlooks that people have provided, you start seeing that as a recurring trend. Another thing that is interesting that a lot of these individuals also shared is that they're not going to be changing their strategies of focusing on the fundamentals. I think, regardless of the time that you're in, real estate is a cyclical business. And so if you really stick to the blocking and tackling of what it takes to be successful in the business, it's going to ride you through the more difficult times. And as we get into 2024, there's definitely a lot more optimism in the marketplace. And if you stick to those basics, you're most likely going to achieve long-term success. One of the things I did notice also when you start looking at some of these other countries is that the sentiment internationally is not quite as positive as it is here in the United States. So even talking to people in London, there was a gentleman that from Madrid, Spain, right here. The outlooks that they have tended to be more pessimistic. And I think part of it has to do with the liquidity in these different markets. Obviously, the U.S. economy is a very large and robust economy. It's the largest economy in the world. And so, from a liquidity standpoint and availability of capital and a lot of investors, the U.S. tends to be one that has a very strong ecosystem. Whereas in some of these other markets, it's not quite the same. And so it just kind of goes to show, be thankful that we operate in this space, in particular in the United States. And so, again, these are just some of the takeaways. Obviously, it's a long article where they had 40 different people. They picked out 40 different responses. Obviously, they interviewed hundreds of different executives, but I thought I'd kind of get your take on this.
Yeah, I love it. I think it actually kind of maps sort of what I kind of thought, right? I was in my head kind of assuming like most people were going to say a pretty positive sentiment for America, right? For the US for 2024. And then personally, I mean, at least from my friends that I know who own real estate overseas, that are also big time investors. I mean, these are not just small players. They have some pretty pessimistic mindsets towards the economy for those overseas. So I feel like this is about par with about what I kind of expected. Nothing too out in the ordinary. And I also want to double down on what you said about blocking and tackling, right? Like getting back to the basics. I think that this industry, for those agents who stick to the basics and get really, really good at prospecting, generating opportunities, and networking with the right folks who are constantly buying more and more properties every year, it's really hard to make less money. Let's just be honest, right?
Yeah.
However, for those of you who get away from the basics and stop doing what works, I think that you'll always come to a moment where you're being like, we probably should get back to the basics. So,
Yeah,
I like the article.
it's the perpetual riding of the roller coaster, right? I mean, as you kind of alluded to, when you do focus on the basics of the business and you become phenomenal at those basics, you kind of level out your income over time. Whereas those individuals who, kind of ride the wave. I mean, obviously, if you're in investment real estate, when interest rates were 3%, I mean, you could have shot, if you found the opportunities, you could have shot it's like shooting fish in a bucket. But in when in a situation now where deals are harder to come by, and when they do come by, it's harder to get them to the finish line. Again, those individuals who have the staying power, those individuals who stick to the basics of just doing what they need to do on a day-to-day basis to execute, obviously they're going to be the ones who have success long term. So just kind of reiterating that point. So all right. So next up, we're going to share one of Henry's articles, which is what to watch in 2024. Multifamily outlook offers demand the chance to match supply.
Yeah. So the reason I wanted to bring this article up, you can kind of scroll through it a little bit. It kind of just mentions how we've been a little bit. So this is a great graph here. So this is kind of just showing you here the multifamily units that have been completed every year. Okay. So what we're looking at here is that we've had some pretty strong numbers the last few years. And for the first time in a while, we're going to have a pretty substantial percentage basis drop off, right? From 23 to 24. We're going to see, I don't remember the exact percentage, but at least just from what it looks like, we're looking at, call it like 10 or 15%, or substantially more. So what that's going to allow is that's finally going to allow us to see that, I think we're finally going to be able to, everyone was kind of freaking out for a little bit that there was going to be like this oversupply, based on demand. And I think I think this is a really smart move. I like that. We're finally going to be in a place where kind of we'll be near equilibrium. I think that also, because I own some multifamily, I'm pretty excited to see that rents during COVID, and through that period of time or slightly after COVID, I was really excited because every single time I put an apartment for rent, we were renting very quickly and always more money, right? There was a very high demand. And then we went through a quick lull period of time where there was just so much opportunity or so much availability, and the demand was not there. So we would have a unit on the market for a little bit longer than expected. And it was tough to get our higher price points now. Sometimes we didn't even get it. So I think now this gives me a little bit more optimism in the markets. And for those people who are in the multifamily sector, this is a time to also be looking at hey, I like existing product. I love existing product. I love existing product that I buy, renovate, make it beautiful. We're going to be able to finally compete a little bit with the development opportunity because at least we're going to have a decent supply demand curve here.
Yeah, no, 100%. And what's interesting too is, even with these numbers, and this is a separate article that I read a little while back, but even hitting the 500,000 as far as new deliveries to the marketplace, that doesn't even really scratch the surface of the amount of the demand for housing in the marketplace. Obviously it's significant. I can't remember the exact article that I read, but if you think about it, we have almost 350 to 400 million people in the United States. There's going to be several million people every year that are going to be churning over, that are going to be in that either house buying phase or they have to find a place to live. And so there's not nearly enough deliveries from a multifamily standpoint, and in particular the single family home standpoint, because it's becoming more expensive. And we'll kind of highlight that in another article later on in this discussion. So, I still think that multifamily could very well be a great opportunity. It's just, again, some of the fundamentals, in particular when it comes to the optimism that had taken place over the last several years. I think that was just exuberance, right? Anytime you're in a market where there's a lot of exuberance and there's people thinking that nothing can go wrong, that's typically when you start seeing issues formulate. I don't think. Go ahead.
No, I was going to say, if you want to scroll down a little bit, because I also like how it talked about the individual markets, like talking about completions by different areas. Here, you could stay here for a second.
Further up. Yeah.
Well, either one. I'm just saying, like, it's just either one of these is like just fantastic to look at because it's like, okay, if you're in the Dallas Fort Worth market, I mean, obviously, like if you look at the amount of completions, right? Where again, this is saying where shows have elevated supply still going to be an issue, right? Like New Jersey, look at New Jersey. I mean, northern New Jersey. This is like I've been saying this for a long time that like this is talking about like right across the Hudson River from Manhattan. They're over. I think they're overbuilt in a lot of areas, and it's like people are trying to still demand high prices, and it's just not happening, right? Miami, I think they're drastically overbuilt in Miami. You know, a lot of different places in Dallas, Fort Worth, overbuilt. New York, completely overbuilt. There's just not the kind of demand that there once was. If you scroll down,
Sure. Please go.
by the way, if you're in these markets, like it's a good thing to be paying attention to. Like here you go. So this is actually interesting, right? Ratio for 2024 completion to inventory, right? So I like being in the places where we're seeing a good ratio, right? Like you're in a place where like you have the ability to actually still make some good money here. Where, you know, unlike New York, if you're investing in places like Orange County, high demand, right? You know, there's a lot of different places here if you just take a look at the map. But you know, people love Columbus, Ohio. There's a lot of room to be built in Columbus, Ohio. A huge opportunity to buy some properties out there. If you have any properties, you should reach out to me because I have some great buyers out there. But there's if you're in the right markets, you should get really really excited. And if you're in a place like New York for a development of multifamily, you're just completely out of the it's just a complete. I would say a waste of time, but it's just you probably can make better money somewhere else.
Yeah, no, I couldn't agree more. I mean, again, I think the 2024 is going to be a year of opportunity, and so I think kind of the moral of the story is that just kind of keep your nose to the grindstone and try to find these opportunities because again, I think it is going to be one year to remember. So, all right. So next up is CRE poses $160 billion risk to U.S. banks, university researchers say. So I think this goes to show the importance of actually reading more than just the title, because if you were to just read this article, you would think, oh my gosh, like you have a significant amount of debt that's potentially coming due, and that's going to be a huge risk to banks. But again, as you start digging into the article, it starts elaborating a little bit more into what that actually means. So just kind of highlighting this quick part of the article to just kind of give you a perspective. So the paper estimates that roughly 14% of all CRE loans and 44% of loans associated with office assets have fallen into negative equity with underlying property values less than the outstanding loan balances. So again, what does that mean? It means that, okay, well, there's 14% of all CRE loans have been not necessarily performing as well as they should have. Now that is obviously a big concern, but the reason most likely that it's 14% is because 44% of the office properties have been the ones who have fallen into negative equity. So that percentage is being skewed upward from a particular property type, and we'll dive into a little bit more as to what that means, even from a suburban versus central business district perspective. But the range that was provided was that 10 to 20% of CRE loans could default. Again, speculation. According to researchers, that stands to stick banks with as much as $160 billion if in the 20% case and $80 billion for the 10% case. So, as we start getting into, deeper into this article, you start realizing, okay, well, the reason, the way that they're projecting this particular problem is one that obviously will bring people's attention to the article. But in reality, as you start actually working through this, you start realizing, okay, well, there's different factors at play that could potentially backstop this issue. And that's what I really, truly believe. Like, I don't believe that the government's going to allow for a mass amount of banks to fail. It kind of talks about some of the banks that would be most at risk. So they said with a 20% default rate, losses tied to CRE loans could result in as many as 67 smaller banks becoming insolvent. So, again, mostly when you think about exposures to some commercial real estate debt, local and regional banks are going to be the most affected because their larger percentage of their portfolios is going to be housing commercial real estate loans. And so, again, I think what's ultimately going to happen, and again, we'll see if this actually transpires, is it in a terrible scenario where 20% of the actual loans default, which I don't think is actually going to happen. You may see some bank closures, but in a scenario where you start seeing massive amounts of banks foreclosing or closing, I should say, there's going to be a backstop that comes into play. You kind of saw with SVB where regulators stepped in and were able to kind of mitigate any concern there as well. So again, I just thought I'd share this article because it kind of illustrates the point that it's really important to really dive in and understand, what the data really says versus just reading the headline and assuming that, things are a lot worse than they actually are. So.
Yeah, I agree. I appreciate you bringing this up. And similar to what you had mentioned, I do believe that we're not in for this craziness that everyone's expecting, especially with interest rates starting to come down, where people could refinance if they needed to, or where people can, a lot of these big players also, like, a lot of the issues that I'm at least experiencing in my local markets for this types of situations, right, where you have a loan coming to due on a property. Number one, the fact that it's hitting metrics where there are loans where if it goes below a certain income level in totality, like if the property starts generating a lower income level, the banks are going to start saying they want the loan to come due, because you can't have a debt service coverage ratio at such a negative rate for such a period of time, where they call in they do a money call, right? Where I'm not seeing that as often. Where I'm seeing it as, lenders are working with the owners. Number one. Number two, the buyers are getting smarter, where they can develop and create opportunities to make money with properties, like office buildings, where redeveloping them, upstairs, and getting approvals to create more value. Right. People are getting just more and more creative these days. And even the situations where I've seen firsthand where loans coming due, they know it, they're interested in selling, there's still an immense amount of equity. So I just think that it's the big players are getting crushed right now. And by the way, you know what the big players are doing? They're just handing it back to the bank. They're handing it back.
Yeah, 100%.
Done. They're not making payments. They're just going, here's the property back. So it's not like there's this craziness, this bloodbath that everybody's experiencing.
Yeah, no, I agree. I mean, and this kind of just goes to show, they talk about, the base scenarios. It's like either a 10% default rate or a 20% default rate. 20% default rate think I mean, this is not a small amount of you're talking about almost a cataclysmic type of scenario. And so, I think it just kind of goes to show that you really need to dive in a little bit further than just reading the headlines, because, in reality, what's actually taking place is more nuanced than what a lot of these headlines are making you believe. So, all right. So next up is the housing market finally poised to see relief?
Yeah. So scroll down through this article. I thought this is really awesome. I love these types of data points when they're putting up. You can keep going. So mortgage rates have obviously peaked for now. At least from what they're seeming like, we were at 7.9% in the mid to late. I think it was like October or something like that. We hit all-time highs, or for at least the last, call it the 2020s. So we're starting to see a downturn, right? We're down in like a 6.5 range, 6.25 range for mortgages. If you keep scrolling down, we're starting to see. I think we're starting to see things open up, right? How low can they go? I mean, we're talking about, the ability of rates starting to inch low. Or sorry, this is actually. This is my home sales. Oh, we had the lowest, by the way, the surplus, but the amount of houses that traded in 2023, I think was the lowest in history, right? Or at least the last X amount of, I don't even know how many years, but a lot of years. So I think that we're in a really, really healthy place. We are poised for a fantastic 2024, I believe, in the real estate housing market. However, because I think once interest rates inch down maybe another point or so, I think it's going to open up a lot, and I think a lot more people are excited to get back out there and start buying some houses.
Absolutely, yeah. So, no, I mean, and obviously, I'm interested to see how it's going to play out this year, because obviously we kind of are under the impression that interest rates are going to come down, but inventory is still relatively low. So you kind of see it here, even with home prices are back on the rise, even after I guess it's more so related to what's been happening in the interest rate environment as well. But I mean, home sales, I don't claim to know a lot about, the home environment or the home market, because I just don't follow it as regularly as I do in the commercial real estate space. But, again,
Sure.
I have a lot of residential friends that kind of share that insight. So
I just like this also because it's like I like to sometimes pick off some smaller rentals, and I like
hmm
to see how the market's turning. So it's good to see. I think that the prices, because housing prices also, I believe they directly correlate to commercial real estate prices. Because like obviously, the better the market for residential, the better the market typically is for commercial.
hmm
At least from my experiences. But yeah,
yeah. I mean, it's a function of everything, right? I mean, residential tends to lead commercial. So if we have issues on the commercial or issue on the residential front, typically it starts to be felt on by commercial real estate, 6 to 12 to 18 months after. So, I think that the fact that the residential market's starting to tick up a little bit, I think is only more of an
good
indication that
news
the
for
commercial
us.
real estate market is going to do well. So,
I agree.
all right. All right. So next up is hotel prices outperform while deal volume falls. So total hotel sales in November were 1.3 billion, down 69% year over year. So this is kind of an article illustrating the somewhat the dichotomy of what's been happening in the hotel market. Obviously, 2020 was very disruptive for hotels. There was crippling issues as far as revenue generation. People just weren't traveling. But once you start getting into 21 and 22, lockdowns ended. Travel improved, and then you had what they described as revenge spending. So people had all this pent up demand for being able to travel, and then there was just an influx in money that came into the market. So, obviously you start seeing here some of the indexes that they've been following were, it grew over by 20% from their lows in 2020. So, I know a lot of people, several people, I should say, not a lot of people, but I know several people who operate in the hotel space, and they've been telling me that the last several years have been extremely great compared to 2020. Now, obviously, what you're still seeing in the market is that as it trading as an investment property, deal volume in investment property has dropped significantly. So the decline in property sales as respect to volume is more so indicative of what the interest rate environment is and the liquidity market is versus the actual performance, because the performance of these assets have actually been pretty good over the last couple of years. So again, I thought I'd share this with you and try to get your take on it.
Yeah, I think that what's interesting is the hotel business, I feel like in a lot of ways has been really, really strong for quite some time. But because I feel like we're kind of just at this place where, because of debt costs and how the trends for travel has changed, I do believe that a lot of these hotels are really hurting. So like if you're in the
Mhm.
hotel business, I think this is a good time to find some great assets to pick up for some great prices. As a broker, I actually do not spend too much time on the hotel side of the business. Every now and again they come across our desks. But I think this is a great opportunity for people to pay attention to it. Like, hey, if you have a great hotel buyer, it'd be a really interesting time to be spending money finding some distressed assets.
Yeah. No, I mean, I'll agree with you. I mean, I don't do too much in the hotel space, but it's more so just from people that I've had conversations with where I've gleaned some insights there. But outside of that, I don't claim to be an expert by any means in hotel real estate. It's definitely a more nuanced business because it actually is an operating business. There's so much more stuff that goes into running a hotel as compared to
You're buying a
uh,
business.
yeah, 100%. I mean,
Buying a business,
you're buying.
buying.
Yep, you're buying something that requires a lot of time involvement. Obviously, there's hopefully commiserate returns with that, but again, it's a different business than what we're typically used to, where you rent out the space and property manage from there. So, all right. So
Yep.
next up is construction spending edges higher. Tesla deliveries rise. REITs outlook seen brightening.
Yeah, so sorry for all you Tesla people, out there. This is not so much
Mhm.
for the Tesla article, but this is I appreciate you stopping right here. So I mean, this is just goes to show the amount of money that right now we're spending, both private public sectors and on the construction cost. I mean, like the amount of money that we're spending for construction is interesting to me because I feel like with demand, like we just saw the development world. Slow down a little bit, right? Like there's not as much development going on in the new year in 2024. However, for whatever reason, construction spending seems to continuously rise. So that means we're doing a lot of renovations, right? So doing a lot of renovations, doing a lot of still doing quite a bit of development. There's a lot of opportunity here when it comes to paying it. I like to pay attention to the construction spending only because I feel like it's been the last like there's been such a massive amount of because the construction costs have skyrocketed, right? So and this is why. I mean, if you look at how much money we're spending on construction, is because we are pushing numbers like we haven't pushed in a very, very long time. So I think it's just equally proportionate to the cost of the construction because there's such a high push for it. So if you're looking to do development, if you're looking to renovate properties, it's getting incredibly costly. And it's just, this is just one thing to be paying attention to.
Yeah, I mean, even if you look for the first 11 months of 2023, spending on all public and private construction topped the year earlier period by 6.2%. I mean, that's a pretty sizable jump. If you talk about multiple, I mean, this is what in the billions of dollars. Yeah, the multiple billions of dollars just in construction for let's see. These are month by month periods. I mean, that's crazy, bro. That's a lot. When you compare it, it's for the month of November, you're talking, roughly $2 billion in construction. And that seems to be a trend over the course of the last couple, the last 12 months to 24 months, really, because this goes back all the way to January of 2019. So it just goes to show the amount of, go ahead.
I was going to say, it just looks like if you look back to January 2019, where we're at just about $1 billion a month, it looks like almost we're spending, 50%, 60% plus more per on a monthly basis than we were just a few years ago. So, I mean, that's obviously just adding to all the demand that has pushed up prices.
Yeah, absolutely. So I'm hopeful. I'm hoping that, construction costs come down a bit because, we're starting to take on some construction projects of our own, more so on the development side. And that's always a factor. You just got to have to.
I don't see it happening.
I know. I mean, hey, you never know, man. I'm hoping at least steel. At least if steel can come down, then obviously I'll be happy. But I guess that's a pie in the sky dream. But all right. So next up is less than 1% of homes are affordable in top California metros. So nationally, only 16% of homes are priced less than 30% of the median monthly income. So I thought I'd share this because it just kind of goes to show the affordability issue that we were facing in a lot of markets. But, it was highlighting it's not the 97 metro areas by population that only 16% of homes are offered in a estimated monthly mortgage range where is kind of comfortable for people, which is less than 30% of the median household income. The worst culprit is San Francisco, Los Angeles, and Oxnard MSAs, which apparently have a 0.3% of homes for sale in these markets are in that range, which is mind-boggling. That's crazy.
It's insanity.
I know. And Miami's not that much better, so we'll get to that in a second. But the results for Anaheim, Oakland, and Sacramento were roughly 1.1%, 2%, and 2.8% respectively. So nationwide, Boise and Miami were among the least affordable metros, with percentages of affordable housing listing at 1% for Boise and then 1.7% for Miami. So, Boise is another one that's kind of shocking to me. I don't know much about Boise, but I do hear a lot of people, in particular from Washington, that come over, and the values in those areas have jumped significantly. I know Wyoming in Jackson Hole is obviously a big market for people relocating from other metros in California, particularly. And the values in those the value of property in that area is skyrocketed. And so residents can't afford to live in those areas. And I'm sure Boise's that way. With Miami, it's different because you got so many people relocating from these large metro areas that make a lot of money. So, obviously there's still volume happening in the marketplace. But I just thought I'd, share this because I thought it was kind of interesting.
It's insanity. I mean, obviously with interest rates coming down, it'll definitely help out the market a little bit. But what's funny is that people always like, oh yeah, well, interest rates are coming down. Like, yeah, but if interest rates come down, home prices are going up. Right. Yeah. So it's just it's not like it has, there's going to be this brief moment where home prices are steady for a half a second before they jump again. So it's just interesting where it's kind of, you're trying to catch a habit that never catch. Trying to catch the market here at the right time where you can find something that's affordable. But yeah, I mean, it's just, this goes to show that hey, especially for something like something like California, where you have such a major discrepancy between incomes and pricing. I mean, we need apartments out in those areas that can be affordable very quickly, right? Because out there, I mean, it's just so freaking expensive to live, at least housing wise. So, having some type of affordable housing out there is going to be a massive opportunity, I believe, for the development side.
Yeah, no, I agree with you, and I don't know. It's just fascinating to me when people say that, where they say, oh, what do you call it? That when they say that that affordability, like, oh yeah, when interest rates drop, it'll be a lot easier to get in the marketplace. But in reality, like you had mentioned
Stupid.
before, it's stupid. It's ridiculous. And especially in the affordable housing category, where you're talking about being in that 30% range or whatever. I mean, that just means that hundreds of thousands of more people are going to be coming into the market. Whereas if you're at the upper end of income and you can afford the higher end properties, like a difference between a point in interest rates not going to really be that big of a deal. Like it's not really.
We are becoming a renter's nation. We are
Mhm.
becoming a renter's nation because people cannot afford that,
Yeah.
right? People can't afford to pay for these huge houses anymore. It's becoming a renter's nation. So buying up some rental property would be a really smart idea. Speaking of which,
Yep. That actually leads us to our next article, which is the last one we've had for at least for today. But what to watch in 2024, multifamily rent growth could begin to accelerate later this year. Sunbelt markets could lag behind other regions due to supply overhang.
yeah. So scroll down to the details here. Yep, here you go. So rent growth. This is, again, we were kind of mentioning this previously. This is quarter by quarter, but this is trying to mention that in Q4 of 2024, you can kind of see towards the right-hand side of the page, you're seeing that in the tail end here of 2023, or even 23 in general, massive downswing, right? I mean, if you look even through 2020 as things spiked out, I mean, like we had crazy rent growth for quite some time. Throughout the mid to late 2022 started to come down. 2023, it's keep coming down farther and farther. 2024, Q1, they're expecting things to kind of bottom out, and hopefully for the rest of this year, that would be amazing to see where rents start to uptick again. I wouldn't say the double digits like we saw during COVID, but definitely seeing a decent, healthy back to normality. I mean, look at 2019. I mean, like this is right before the COVID spike, right? I mean, this is very normal for things to be in the 2 to 3% range. The fact that we're sub 1%, I mean, this is obviously just not sustainable.
Yeah, no, I agree. I mean, and obviously that's going to be a function of the new construction that's coming to market. Those new builds are coming online, but also they're not building as much anymore because there's still kind of a holdback from developers to be able to bring new product to market. So obviously this is going to restrict supply, which means we're going to have more of an increase in pricing for rent. Now, I think it'd be great for us to get back to a normal range where it's like the 2 to 3 to 4% max. Because once you start getting into that, 10% territory like we saw in 22, I mean, that's just not feasible. It's not sustainable. And
No.
you talk about crisis. I mean, that would be a crisis if we had people not being able to afford rent, right? A lot more.
I mean, what's crazy though, which I want to bring up here, is that like in Miami, a lot of our friends who are renting locally, they're in condos, apartments, what have you, and upon renewals, they're asking for 10 to 20% increases. Or actually, sorry, not 10. It's one of our friends was 40%, right? And it's like they are like trying to achieve such crazy high numbers. I mean, it's absolutely insanity. I've never experienced this in my life. They have a rent for $3,000, now they want 4,000, right? It's like it's crazy to me. I mean, obviously out here in Miami, that there's no rent control, which is nice for their owners. But as a tenant, it's not going to be that great. You just need to be cognizant that, like, hey, like this is what you need to be prepared for. Listen, a lot more people are renting these days, and it's good to be a landlord in a lot of great areas. Just be cognizant where you're buying, because regardless of what rent growth looks like, I owned a property in a rent controlled area. Even though rent growth was through the freaking roof, I couldn't do anything about it. It's like, oh, I was limited to 3.5% a year. It's like 3.5% of a person I inherit of a property I inherited tenants with $1,000 rent, $30 a month. It's like when market value is like $1,800.
Mm-hmm.
So it's like I was the loser there.
Yeah, 100%. And those tenants aren't moving because they know if they move, they're going to
No.
have to pay market rate, and you can bring
Yep.
that back up to market. And I have a buddy out in California who's a broker, and they sell a lot of multifamily product, and that's the stuff they have to contend with. But sometimes that could be an opportunity for you to buy low, and as you kind of get certain units to turn over, then you could bring it back up to market. But it is much
Yeah,
much more difficult to contend with than a free market like Miami is. So.
that's for
All
sure.
right. All right. Well, if you
Well,
guys are tuning in, please type away in the chat box. Tell us where you're tuning in from. We'd love to hear where you guys are coming in from. And yeah, I guess we'll leave it up to Q&A for at least a little while. We're gonna have to jettison off in the next 5 minutes, but
yeah. Well, listen, in the meantime, Happy New Year, everybody. This is the first episode of the new year. We're obviously excited to, have you guys tuning in. It means the world. Hope you guys had a fantastic holiday and are hitting it hard already. Obviously a lot of sellers take some time off and it's time to get back on the phones and hit it hard. Again, we've been rocking strong since the first. We've been going strong since the first here, making our calls regardless of what everyone says about not making calls on the first. But it's important to pay attention, like we mentioned at the very beginning. Like if you want to achieve some great success in the commercial real estate world, get back to the basics, hit the phones, generate some great opportunities. It'll be hard for you to have a worse year than last year.
definitely. All right. So Zachary, he's tuning in from Chicago. Great to see you, man. I believe you've been on the stream before, so welcome back.
That's how we do it, Nick. And anything else that thank you for giving us some thumbs up. We appreciate that. And remember, every single time or any time that you'd like, you guys can send us deals if you'd like us to check them out to deals@thecrenewshour.com, deals@crenewshour.com. I'm going to drop it here in the down below. Deals@crenewshour.com. Just put the property address in the subject line. We'd be more than welcome to underwrite any types of properties you'd like, try to help you find a buyer for them. Other than that, Raphael, anything you'd like to say to our beautiful audience today?
Not much, man. I'm just really thankful to be continuing to do this. I think 2024, as I said, is going to be a phenomenal year for those individuals who capture this opportunity. And what it takes is, as Henry said, getting out there and pounding the pavement and trying to generate opportunities for you and your clients. And hopefully, even in the future, I know you're pursuing it as well, but trying to also get on the investing side as well. I think it is important for us brokers to start thinking about ways to generate additional income through ownership of assets. I do think that's a way to be able to build generational wealth long term, and that's part of the reason why we get in the business. So
that's right. Well, look, we appreciate everybody tuning in. Thank you so much. Obviously this was a short and quick episode. We'll see you guys next week. We appreciate you.
See you guys.